Hey guys, today we're getting into chapter 21 of the Builder's Guide to Accounting. If you guys have any questions, you can text this number here. If you guys are interested in joining the course, link down below. And if you guys want free practice quizzes, there is a link down below to download free practice quizzes for the Contractor Manual or Builder's Guide to Accounting. And if you guys want to hire me to do a one-on-one tutoring call with you, link down below as well. So let's get right into the video. Okay, now we're getting into chapter 21, pretty important chapter and long chapter, so let's get into it. There are three distinct financial statements. Each one serve as specific function. The balance sheet, the income statement, the statement of cash flows. The balance sheet. The balance sheet is a summary of the existing conditions of the business. It's called a balance sheet because its line-by-line details show the balance of general ledger accounts. The balance sheet lists the assets, liabilities, and net worth of a business as of a given date. Right here, assets minus liabilities equals net worth. You've probably seen this multiple times. It's in the beginning of the Builder's Guide to Accounting and also in the Contractor's Manual. Super important ratio. The income statement. The income statement summarizes business operations within a time period. So if they ask you, what statement summarizes business operations within a time period? The income statement is broken down into more or less standard divisions right here. The statement of cash flow. The statement of cash flow is a summary of the sources of and use of cash, where it came from and where it went for the same period covered by the income statement. The statement of cash flow has two sections: the fixed or long-term provision of funds, which includes net income, the change in current assets and liabilities. Balancing financial statement relationships, the balance sheet, the income statement, the statements of cash flow right there. Okay, the trial balance. After you post your ledger at the closure of the period, the first step is preparing financial statements, is to put together a trial balance. Closing adjustments. Here are some typical adjusting entries right here. Okay. It goes over 9 through 10 here too. Balance sheet accounts, current assets. Current assets are liquid assets, assets available to the builder within 1 year. I always say this in all my videos, you gotta know what current means. Current means within 1 year. This means that they could be turned quickly into cash. The asset accounts include cash, accounts receivable, inventories, and other current assets. Fixed assets. This account category includes the gross value of equipment and machinery, small tools, improvement, furniture, fixtures, structures, and land, less a reserve for the depreciation that you've expensed for them. These assets are fixed because they aren't available to be turned into cash within 1 year. Other assets. Goodwill is an example of an intangible asset. The seller of a business often adds a goodwill value to fixed assets, inventory, and other tangibles. Convenient not to compete. Goodwill can't be amortized or depreciated, and it remains at its original value indefinitely. Current liabilities. Like current assets, which are liquid and convertible within 1 year, current liabilities are payable within 1 year. Long-term liabilities. The most common type of long-term liability is a long-term note or a contract payable. Other liabilities. Long-term liabilities will eventually become current liabilities, but deferred credits are likely to be clearing or wash items that enter this account and are soon cleared back out again. Contingent liability. A possible debt from a pending lawsuit or a potential unrecoverable loss are example of contingent liabilities. Equity account. Partnerships have an account called partners' equity, while corporations have an account called capital stock. Amounts withdrawn, called draws, are deducted from profits. This provides a yearly running balance of each partner's investment balance in the company. Okay. Retained earnings. Corporations have a retained earnings account in addition to a capital stock account. Once the corporation is operating, each year's profits, losses end up in this account. Net profit. This account may be called a retained earnings account. Corporations or an equity account, partnerships. Direct costs. It's important to distinguish direct costs from operating expenses. Find the gross profit figure, a significant indicator on income statements, by subtracting direct costs from net sales. Operating expenses include in this account all indirect expenses. Tax provisions. This account category should include federal, state, and local taxes, even if you haven't paid or deposited the amount yet. Statements of cash flow categories. Changes in long-term assets and liabilities and capital accounts. The change from the end of the previous period to the current period is shown in detail by type of change. These changes include two major divisions: source and application of funds. Sources include, and then applications include. Their summary of net changes in working capital. The second section of this report is a summary of net changes for the period in your working capital. The term working capital refers to the net difference between current assets and current liabilities. Footnotes to financial statements. The final section worth discussing is the footnotes to financial statements. These can be brief or highly detailed. While the tendency is to view footnotes as not very important, that's not the case here. They should always be read with great care, as many items affecting financial strength won't be reported on the financial statements, but could be noted in the footnotes. All right, that's it for chapter 21. We'll be getting into chapter 22 now.